Yes, so the first thing we need to ask ourselves here, what is diluted earnings per share? Basically, a diluted earnings per share is earnings per share which is computed by a company by taking into account what are known as potential ordinary shares. Potential ordinary shares. In other terms, this diluted earnings per share has to be computed by those companies which have dilutive or which have dilutive potential ordinary shares. And in this case, when we talk about a potential ordinary shares, we are referring to those ordinary shares which are likely to be issued by the company in the future. So why is the company likely to issue ordinary shares in the future? One is because the company has already entered into contract, for example, with the employees, which requires the company to issue ordinary shares to the employees in the future. A good example of such a contract is what is known as a stock option, or maybe what if that is a share option. A share option is basically an agreement or a contract between the company and the employees that the company will issue ordinary shares to the employees in the future, maybe at a price below the market price. So therefore, such a company, because it will have to issue some shares in the future, then we say that those shares which will be issued in the future, they will dilute the interest of the current shareholders. And therefore, any company which has potential ordinary shares has to compute the diluted earnings per share in accordance with what refers as IAS 33. So therefore, in this case, the first important point here is to note is that IAS 33 requires companies which have potential ordinary shares. I'll be able to explain more in details what is that. Potential ordinary shares. Potential ordinary shares to compute diluted earnings per share. So therefore, this is earnings per share in other terms, which is computed by those companies which have got potential ordinary shares, Now, what are potential ordinary shares in this case? Abbreviated as POS. Potential ordinary shares. So these basically are contracts which the company has entered into, or financial instruments which have been issued by the company. And therefore, this contract or this financial instrument issued by the company, they requires a company to issue ordinary shares in future. To issue ordinary shares in what? In future. So therefore, potential ordinary shares, we are saying, is any contract which the company has already entered into, or a financial instrument which the company has issued, and it requires the company to do what? To issue ordinary shares in what? In the future. To issue ordinary shares in the future. To issue ordinary shares in the future. In the future. Now, Robert, what is happening to my board? You're saying is not clear. Robert, my board is not clear. You're saying my board is not clear. What is happening, Robert? Is my board?
Recording in progress.
Yes, I can see it's not that very clear, but I think there will be some improvement. I think maybe it is the internet which is fluctuating, but maybe let's hope it will improve. So now, in this case, we are saying potential ordinary shares, these are contracts, or basically financial instruments, a contract which the company has entered into, financial instrument issued by the company, and basically which requires the company to do what? to issue ordinary shares in future. Now, what are good examples of these potential ordinary shares? One, we have what we refer as the stock, or basically what we refer as the share options. The stock or share options, we know that these are contracts which the company has entered into with the employees, whereby the company has agreed with the employees that once the employees have been able to fulfill certain conditions, for example, they have worked with the company for a certain and minimum number of years, they will be issued with the shares of the company basically in future at a price below the market price. That is a contract which requires the company to do what? To issue ordinary shares in the future. Another good example of potential ordinary shares is something called the convertible securities. Convertible securities, e.g., convertible debentures. We know that convertible debentures, these are those particular debentures, once they have been issued by the company, then they can be converted into ordinary shares. And therefore, if the company, for example, has issued convertible debentures, it basically means that the holder of those debentures in future can convert them into ordinary shares. And therefore, once the company eventually issues these ordinary shares because of the contract it has already entered into, or because of this financial instrument which the company has already issued, e.g. convertible debentures, then we say that the interest of the current shareholders will be diluted. And therefore, such a company which has got some potential ordinary shares is required to compute and do what? And disclose the diluted earnings per share together with the basic earnings per what? Per share. Now, how is this diluted earnings per share computed? So the diluted earnings per share is computed by adjusting the profit attributable to ordinary shareholders and the weighted average number of ordinary shares, because we say to compute basic earnings per share, we take PATOS, profit attributable to ordinary shareholders, divided that with 1/0. Now, we adjust these two figures. First of all, the PATOS, this one is adjusted with something called the increase in earnings. I'll be able to explain what we mean by that. And then this one, we adjusted with something called the increase in number of what? Shares. Increase in number of shares. That's basically how we compute the diluted earnings per what? Per share. Let me explain what we mean by this. Let's assume we are told a certain company, for example, company X, has issued maybe convertible debentures. Convertible what? Debentures. So company X has issued convertible debentures, and maybe we are required to compute the diluted earnings per share. Now, for the purpose of computing the diluted earnings per share, one, we make an assumption, or in other terms, let me say this. In computing the diluted earnings per share, or the diluted earnings per share is computed on the assumption that the potential ordinary shares issued by the company were converted into ordinary shares during the current year. So therefore, diluted earnings per share is computed on the assumption that the potential ordinary shares were converted into ordinary shares during the current year. For instance, if you're told a company has issued convertible debentures, for us to be able to compute the diluted earnings per share, we assume that these convertible debentures were converted into ordinary shares during the current year. So therefore, that is very, very important, that diluted earnings per share is computed on the assumption that the potential ordinary shares were converted into ordinary shares. If the company has issued convertible debentures, assume they were converted into ordinary shares during the current year. And therefore, if these debentures were converted into ordinary shares during the current year, then you ask yourself, what basically would have happened? What if these particular debentures were converted into ordinary shares? What would have happened? Two things would have happened. One, the number of ordinary shares issued by the company, number of ordinary shares issued by this company, automatically those shares would have increased because our debentures were converted into ordinary shares. Our company would have issued ordinary shares. So therefore, the 1/0 here, the weighted average number of ordinary shares would have increased. And actually, that number of shares which would have been issued is now what you're referring to as the increase in number of shares. These are the number of shares which would have been issued by the company, assuming the debentures were converted into ordinary shares. And actually, for you to be able to compute that, always will be provided with the conversion rate, the rate at which now these debentures are supposed to be converted into ordinary shares. So then what you do, you compute the number of ordinary shares which would have been issued, assuming these debentures were converted into ordinary what? Shares. The other thing which would have happened is that the interest which is payable on debentures, the interest payable on debentures, this particular interest would not have been paid. Would not have been paid. Why? Because the debentures were converted into ordinary shares. The company instead would have paid what? Dividends. The company would not have paid that interest. So if this interest was not paid, and we know this interest is an expense, it basically means that the profit attributable to ordinary shareholders equally would have increased. Equally would have what? Increased. So what you need to do is basically compute that particular profit for the current year would have increased with an amount of how much? And basically that is what we refer to as the increase in earnings. So that's why we are saying in computation of diluted earnings per share, we compute it by taking PATOS, we add the increase in earnings. This is basically the amount by which the profit for the current year would have increased with, assuming our debentures were converted into ordinary shares. And then we take our NOS, we add the what? The increase in number of what? Shares. Increase in number of shares. These are the shares which would have been issued on the assumption that our debentures were converted into what? Into ordinary shares. So therefore, generally, that is how we compute what? We compute now the diluted earnings per share. Now, in this case, we have various types of potential ordinary shares. And basically, I want us to look on how we deal with them, specifically in computation of diluted earnings per share. So the various types of potential ordinary shares which a company may be having may include things like convertible debentures, convertible loan stock, convertible bonds. All these are treated in the same way. Then we also have the convertible preference shares, convertible preference shares. We also have what we call as the bonus issue, the bonus issue. We also have others which are known as contingently issuable shares and also partly paid shares. Those, though they are not very, very common in an exam setup. So I think in our case, I'll just be able to discuss on those three: convertible debentures, convertible loan stock, convertible bonds, convertible preference shares, and also no, sorry, this should not be bonus issue. Sorry for that. This should not be bonus issue, but rather this should be the stock or the share options. The stock or the share what? Options. The stock or the share option. The stock or share option. So Robert, I think you'll be able to understand more on your question. So just pay attention. That is what I want us to discuss in details. The question you're asking. Yes, so let's start by looking on how we deal with this one in computation of diluted earnings per share. Convertible debentures, convertible loan stocks, convertible bonds. So remember, this is a good example of the potential ordinary share. It's a financial instrument which has been issued by the company and which requires the company to issue ordinary shares in the future once the holders of these securities convert them into ordinary shares. Now, what you have said is that for the purpose of computing the diluted earnings per share, we make an assumption, or we ask ourselves, what if these convertible securities were converted into ordinary shares? What if they were converted into ordinary shares? What would have happened? We have said in this case two things. Number of ordinary shares issued by the company would have increased, and number two, the profit attributable to ordinary shareholders would have increased because the interest payable on these debentures, loan stock, or bonds would not have been paid because those bonds, those loan stock, those debentures were converted into ordinary shares. And therefore here, you come and compute two items. You compute two items. One, you compute something called increase in earnings. But it's also very, very important for you to recall, you compute this increase in earnings, increase in number of shares on the assumption that these particular convertible securities were converted into ordinary shares. So the increase in earnings, or in other terms, the profit attributable to ordinary shareholders, would have increased with what? With the interest which was paid. So compute how much interest was paid by the company in relation to these convertible debentures. And then because interest paid on board, the interest paid on loan stock, the interest paid on debentures is tax allowable. That is what we know from taxation is tax allowable. We must multiply that with 1 minus tax rate. 1 minus what? Tax rate, simply because it's allowable. So that's basically how we compute the increase in what? In earnings. How much interest was paid? Multiply that with 1 minus tax rate. Then number 2, compute something called increase in number of what? Of shares. Increase in number of shares. So here, when we talk about the increase of in number of shares, here we want to know how many ordinary shares would have been issued by our company, assuming these particular convertible securities were converted into what? Into ordinary shares. And actually, for you to compute this, you use the conversion rate which is provided. Use the conversion rate which is provided. So the examiner will always give you the rate at which this particular debentures, bonds, or loan stock can be converted into ordinary what? Shares. So therefore, for you to be able to compute the diluted earnings per share, in case you're given this as the potential ordinary share, you have to compute those two items. Increase in earnings, that's how we compute it. Increase in number of shares, use the conversion rates. So then number 2, we have the what? The convertible preference shares. Convertible preference shares, you can see that these are preference shares and they are convertible. They are convertible. So therefore, it's not any other preference shares we use here, only preference shares which are convertible. So for you to compute the diluted earnings per share, assuming a company has got these potential ordinary share, you equally ask yourself, what if these particular convertible preference shares were converted into ordinary shares? What would have happened? 1, the number of ordinary shares issued by the company would have increased, and also the earnings attributable to ordinary shareholders would have done what? Increased, and therefore come equally compute these two items. Increase in what? In earnings. So the increase in earnings in case of these preference shares is equal to what? This one is equal to the preference dividend which was paid, or in other terms, the preference dividend for the year. For the year, because if those dividends were not paid, then the profits attributable to ordinary shareholders would have increased with that amount. And this one, we don't deduct it. Sorry, we don't multiply this with 1 minus tax rate, because dividends are not tax allowable. Dividends are not tax allowable. That is what we know. So that one is not deducted with 1 minus tax rate, like what we do in case of interest here. So number 2, we can also compute the increase in number of shares. Number of shares. So this one, we just use the conversion rate provided, just like what you have said there. Use conversion rate. Use conversion rate, which is provided. The rate at which now these convertible preference shares can be converted into ordinary what? Shares. And finally, we have what we refer as the stock options. The stock options, in other terms, you also refer to these as share options. Share options. Share options. Share options. So share options, or basically stock option, we know that this is an agreement. In other terms, it is a contract which the company has entered into with the employees. And actually, the company has agreed to issue shares to the employees in the future once the employees have met certain conditions, which, if you can be able to remember the topic of share-based, we refer to those particular conditions as what? As vesting conditions. For example, the employees have worked with the company for a certain minimum number of years. So the employees will be issued with the shares at a price below the market price. Now, therefore, what basically here we also do is we ask ourselves, what if the employees of the company exercised this share or stock option during the current year? So if they exercise the stock option during the current year, automatically they would have been issued with the shares of the company at a price below the market price. So therefore, as a result of that assumption, you proceed and compute two items here. Increase in what? In earnings. So, and then number 2, the increase in number of shares. Increase in number of what? of shares. Now, the first thing you need to ask yourself for you to be able to determine how we determine the increase in earnings. Increase in earnings, remember, we are saying that this is the increase in profit, or in other terms, this is the amount by which the profit for the current year would have increased with, assuming the employees exercise the stock option. One, what you need to note is that if, for example, you're given this privilege as an employee to buy the shares of the company in the future at a price which is below the market price, there is no return which you're entitled to from the company, no return you're entitled to from the company until you buy the shares. So once you buy the shares, maybe that is the time you'll be entitled to dividends. So therefore, even if you exercise that stock option, if you exercise that stock option during the current year, the company will not make any savings. It is not just like boats here or debentures, whereby we are saying if you're issued with a boat, you're entitled to interest. So if you convert those boats to ordinary shares, the company will do some savings. The company will not pay you interest. So if you have been granted this stock option, it is obvious that there is no any return you're entitled to from the company. So even if you exercise the stock option during the current year, you buy the shares of the company, there will be no savings by the company. So, and therefore, as far as the stock option or share option is concerned, the increase in earnings is always equal to zero. There will be no any savings by the company, which will increase the profit. That's why we say increase in earnings here is equal to zero. Number two, to compute the number of ordinary shares here, we are saying if the employees exercise the stock option during the current year, it is obvious that they would have been issued with the shares of the company. They would have been issued with the shares of the company, but at a price which is below the market price. At a price which is below what? The market price per what? Per share. If you can be able to remember on Monday, what we said is that anytime the company issues shares at a price which is below the market price, then the shares which have been issued generally should be split into two components. The shares which have been issued at full market price, shares which are issued at full market price, and if you can be able to recall, we say to compute this, we have to compute how much amount was received by the company from those shares which were issued. How much money was received by the company? And actually, this is something we discussed at the basic earnings per share, specifically when we are looking on shares issued during the current year in exercise of stock option. So compute how much amount was received by the company, and then divide that with the average market price. Average market price. That is basically how we compute the shares which are issued at full market price. And then number two, we compute the bonus element. Bonus element, these are shares which would have been issued free of charge. And actually, to compute this one, we still use the formula which we discussed in our previous class. Take the total shares which automatically would have been issued to the employees, and then deduct the shares which would have been issued at full market price. Issue at full market price. And actually, the formula for computing that is what we have here. Now, once you have done that, you have splitted these shares which would have been issued to the employees into two components. The shares which would have been issued at full market price and the bonus element. These particular shares here which would have been issued at full market price, we say that these shares are not dilutive. They are not dilutive. What does that mean? These shares do not reduce earnings per share. Do not reduce earnings per what? Per share. And there is something I think I've already mentioned here. In computing this diluted and the DEPS, diluted earnings per share, we use potential ordinary shares which are dilutive. What do you mean by potential ordinary shares which are dilutive? These are potential ordinary shares which reduces the earnings per share. Which reduces the earnings per share. Those are the potential ordinary shares which use. They are those potential ordinary shares, or those shares which will be issued by the company in the future. They are not dilutive. They do not reduce the earnings per share, like this one. So if the company happen to issue some shares or will issue shares in the future at a full market price, those shares, they are not dilutive. Why are they not dilutive? Is because once these particular shares are issued, generally what we know is that in computing the earnings per share, we take the profit for the year, we divide that with the number of ordinary shares. This is the general formula for computing the earnings per share. So these are the shares which will be issued at full market price. If you issue shares at full market price, what does that mean? It means one, the number of ordinary shares which you have issued here will increase. That is the denominator. Will increase. Number two, because you have issued these shares at full market price, you are going to receive money equivalent to the market price of the shares you have issued. Once you receive that money, or in other terms, we say you receive resources as a company, which is equivalent to the market value of the shares which have been issued, those resources or that money you invested. Once you invest that money, what happened to your profit? Your profit also go up. So you can see these shares which are issued at full market price, they increase the profit, they increase the number of shares. So therefore, the earnings per share here may not be affected because denominator and numerator are increasing. So, but if, for example, you just increase this one, the denominator, this one remain constant, the earnings per share will do what? We reduce. So here we are increasing the profit because we are receiving additional money. We're also increasing the denominator. So the earnings per share will not be diluted. So therefore, these shares, that's why we are saying they are not dilutive. And because they are not dilutive, and when computing the earnings per share, we use the shares which are dilutive. Therefore, these shares are ignored for the purpose of computing the diluted earnings per share. We don't use these shares which are issued at full market price in computation of diluted earnings per share. They are not dilutive. They do not reduce the earnings per share. So therefore, in computation of diluted earnings per share, we use the bonus element. And actually, this is how we compute the bonus element. Total number of shares which would have been issued to the employees minus the shares issued at full market price. And therefore, what is important here for you to note is that when dealing with a stock or a share option, the increase in number of shares, this one we say is equal to bonus element. Is equal to bonus element. And then you have to recall the formula for computing the bonus element. The formula for computing the bonus element. The formula for computing the bonus element is equal to total shares which would have been issued to the employees, because remember we are computing this increase in number of shares on the assumption that the employees exercise the stock option during the current year. So if they exercise the stock option during the current year, they would have been issued with how many shares? Total shares which would have been issued to them minus the shares which would have been issued at full market price. And actually, to compute these shares which would have been issued at full market price, this is the formula which we use here. You also have to record that total amount which the company would have received if the employees exercise the stock option during the current year, divide that with the average market price per share. Average market price per share. That is basically how we compute the bonus element. The bonus element. In computation of the bonus element of the shares which would have been issued free of charge, that is basically the formula. Total shares which would have been issued minus those particular shares which would have been issued to the employees at full market price. So basically, those are the three types of potential ordinary shares which will be examined in most of the questions. But if you check on the notes which I've shared with you, you'll be able to see we also have others which are known as contingently issuable shares. So these are basically shares which the company is supposed to issue, for example, mostly to the executives, to the senior employees, or maybe to the senior managers once they meet certain conditions in the future. Mostly these are treated in the same way, just like the stock option. But now these shares are to be issued to the senior managers in the future once they have met a certain condition. For example, the profit of the company has exceeded a certain amount. Sasa, yes. Now, in computation of the diluted earnings per share, there are some steps which are followed. If you come across a question, you are required to compute the diluted earnings per share. Which steps do you follow? One is that you need to go through the information which you are given by the examiner, and you do what? You identify the potential ordinary shares which the company had in the year under consideration. Go through the information provided, identify the potential ordinary shares of the company during the year. Identify potential ordinary shares of the company during the year. During what? During that year. Identify the potential ordinary shares of the company during the year. In this case, you have said the potential ordinary shares will include all convertible securities, convertible debentures, convertible bonds, convertible preference shares, and so on. And also this will include the stock or share options to be exercised in the future. To be exercised in the future. To be exercised in what? In the future. Yes, that is the first thing you need to do. Number two, step number two. Step number two, you then compute the following. Okay, we can just say this. For each potential ordinary share, compute the following. One, increase in earnings. Increase in earnings. And actually, we have looked on how to compute the increase in earnings for various types of potential ordinary shares. And number two, compute something called the increase in number of shares. Compute the increase in number of shares for each potential ordinary share. And step number three is that you compute the diluted earnings per share. The diluted earnings per share using the formula which I've given you. The PATOS. And then to the PATOS, we add what? The increase in earnings. And then we divide that with what? With 1/0 plus increase in number of what? Of shares. Increase in number of shares. So that is basically the formula which we use in computing what? In computing the diluted earnings per what? In computing the diluted earnings per share. Three basic steps. Step one, you identify the potential ordinary shares which the company had in the year under consideration. Step two, for each potential ordinary share, compute what? Compute the increase in earnings, increase in the number of shares. Step number three, you compute the diluted earnings per share using this particular what? Formula here, using this particular formula. Okay, so I think we are done with our discussion here. What I want us to do now is we do a question. We do a question from a past paper. You see whether we can be able to do at least two. I want us to start with a question here for which sitting April 2023. April 2023. April 2023, which is no, this is December. Sorry, this should be December 2022. Should be December 2022, not April. Which is question number what? This is question number 4. Question number 4. Question number 4. Question number 4. I hope you're there. Question number 4. Question number 4. Question number 4. Are you there? Are you there? December 2022. Question number 4. Are you there? Are you there? Are you there? Yes. So we go through it. We see what we are told. So number one, this basically was a theory. It requires in context of IS 33 earnings per share explaining the following terms. One, we have contingency issuable. So in the notes which I've shared with you, is clearly explained, but I can also explain this. Contingently issuable ordinary shares. So when talk about contingently issuable shares, these are ordinary shares. These are what? These are ordinary shares to be issued in the future. To be issued in the future to the senior employees, So in this case, when talk about the senior employees, or basically let's not talk to the, and let's not talk of senior employees. We can just talk of the senior managers. The senior managers upon fulfilling certain conditions. Upon fulfilling certain what? Conditions. That's why we have the word contingent. Contingent, we know, is something which is probable. So these are shares will only be issued if those conditions have been met. They have been fulfilled. And usually one of the conditions which is set, and these are shares are usually issued by most companies. Like if you go to these big corporates, Equity Bank, Coop Bank, and so on, they usually issue shares to their employees in future, or basically once not in future actually, once those employees have met certain conditions. For example, a branch manager may be given a target, and he is told that if the profit of the company or the profit of this branch exceeds this amount, then you have the right to buy the shares of the company at a price which will be below the market price. So therefore, those shares will only be issued to such a branch manager if he is able to meet that target. He is able, the profit of that branch has exceeded that amount, contingently issuable shares. Then the other term is potential ordinary shares. Remember, you've already defined potential ordinary shares. We have said is a contract or a financial instrument which requires the company to issue what? Ordinary shares in what? In the future. Is a contract or a financial instrument requiring the company to issue ordinary shares in what? In the future. You can also give examples. Examples of potential ordinary shares include convertible securities and stock options. And what? Stock options and stock options. So basically that is the explanation of that, though in the notes which I've shared with you, we have a very, very clear explanation of the same. So let's go to part B. So in part B, what are we told? We are told delimited equity balances, delimited equity balances as at 1st of October 2020 comprised of the following. Equity balances, we know equity comprises of share capital and reserves. So we have the ordinary share capital. We have 10% irredeemable preference shares, share premium, revaluation surplus, retained earnings, shareholders fund, or the total equity. And then you're given the trading results for the year which for the company, as follows. We are given the trading result for 2 years, 2022 and 2021. We are given the profit after tax for the 2 years there. And then we also have some additional information. Number one, you're told on 1st January 2021, the company issued 400,000 ordinary shares at full market price. Number two, we are told on 1st of April 2021, the company made 1-for-5 bonus issue. 1-for-5 bonus issue of ordinary shares to the existing shareholders, utilizing the retained earnings. 3, on 1st December 2021, delimited invited ordinary shareholders for right issue in proportion of 1-for-4 at a price of all at shillings 12 per share. The shares were quoted immediately before the right issue at shillings 15 per share, or the right were fully subscribed for. The company had initial 12%, sorry, not 12%, sorry, had initial a convertible loan stock of sh 6 million, which carries an effective interest rate of 8%, each shillings 1,000 nominal value of the loan stock will be converted at the holder's option into 600 ordinary shares. And then you're told on 1st of June 2022, the holders of shillings 1.5 million loan stock exercise their conversion option. 5, we are told that the income tax rate applicable to D Limited is is 30%. And then you are told number 6, the company declared and paid dividends on both classes of the equity shares. So what are we required to do? Part A, we are required to compute the diluted earnings per share of this company for the year which ended 30th of September 2021 and 30th of September 2022, 8 marks. And then Roman 2 of the question, we are required to compute the diluted earnings per share for the year which ended 30th of September 2022. So we start with the Roman 1 of the question, whereby we are required to compute the basic earnings per share for the year which ended 30th of September 2021 and 30th of September 2022. So in other terms here, we are required to compute the earnings per share for 2 years, the basic earnings per share for 2 years. So what do we need to start with here? The first thing we must have is the formula for computing the basic earnings per share. So this one is computed by taking the PATOS divided that with 1/0. Divided that with what? 1/0. And because we are required to compute the basic earnings per share for 2 years, always you start with the year coming first. We are going to start by computing the basic earnings per share for 2021. You can't start with the 2022. You have to start with 2021. So therefore here, we start by computing the basic earnings per share for the year which ended 30th of September 2021. So for us to do that, we need to have these two values there, PATOS and what? 1/0. So let's start by computing the PATOS. And actually for the PATOS, you have to recall that we compute this by taking what? By taking the profit after tax or the net income. The net income is something we discussed in our previous session, or the profit for the year. The profit for the year, then you less the preference dividends, and also you less any profits attributable to the non-controlling interest. Now, below the information we have at the paragraph 2, let's go to the information at the paragraph 2. So you can see we are given where we are given the trading results of the company. We are interested with the trading results for 2021. So what we do, we take the profit for the year, and I hope you can see those figures are given in thousands of shillings. So we're given the profit for the year and after tax. That is now what we start with here. Profit for the year, which is the same as the profit after tax, which can also be known as the profit after the net income, that is. So for 2021 is 3146. 3146. So to this we said, basically we less a number of items. One, in case we are dealing with a group of companies, to this we said we less the profit attributable to the non-controlling interest. But now, if you check on this question here, this is basically a question for a single company. That's why you're told this information relates to D group, not D group, sorry, D Limited. So there is nowhere we are given any information about profit attributable to NCI at the paragraph 1, at the paragraph 2, and in the addition information number 1 to note number 6. We don't have profits attributable to NCI. Equally, we said we should also adjust this with any profit or loss from discontinued operation. Are we given such information in this question? No. So the other item we also less from this are the preference dividends. The preference dividends. And I think we have the preference dividends information about this one. And it's also important to note that this year, the first year, ended on 30th of September 2021, it is obvious that this year started on 1st of October 2020. That is now when the year started. So meaning that the information which we have at the paragraph 1, the equity balances on 1st October 2021 are the balances at the start of the year. At the start of what? Of the year, at the start of the year. So therefore, if you go to the information at the paragraph 1, the equity balances at the start of the year, you can see this company had issued ordinary shares, and equally the company had issued 10% irredeemable preference shares. Irredeemable, you can see the examiner is very specific that the preference shares are irredeemable preference what? Shares. Why is the examiner very specific? Is because we said that if, for example, the preference shares which were issued by this company were redeemable preference shares, then we said we don't list their dividends there. We don't list their dividends here simply because the dividends on redeemable preference shares, we said that these dividends are classified as part of the finance what? Cost. Finance cost we know is an expense. This is an expense. And therefore, in arriving at this particular profit, the finance cost has already been deducted, and it includes what? Dividends on redeemable preference what? Shares. But because these preference shares are irredeemable, we are going to rest their dividends here. How do we compute those dividends? We take 10% of the amount of preference share capital, because you can see the preference shares, they were 10%. So the dividend to be paid by the company is 10%. 10% of the preference share capital, which is 8,000. So that will give us what? It will give us 800. It will give us 800. It will give us 800. That's how we compute the preference dividends. The preference dividends. The preference dividends. Yes. So the preference dividends, and actually we don't have anything else to be adjusted to that what? A profit. So what we get here is the PATOS, profit attributable to who? To ordinary shareholders. So this will give us what? 2346. 2346. 2346. So having that, then what else do we need to compute to determine is the one-off weighted average number of ordinary shares. How do we compute this one? We compute this by taking the ordinary shares which had been issued at the start of this year. And it's also important to note that in this question, we have information for 2 years. The first year ended 30th September 2021. The second year ended 30th of September 2022. First of all, we are computing the basic earnings per share for the first year here. The basic earnings per share for the first what? Year. So therefore, we take the shares which had been issued at the start, we add the other shares which were issued during that year. So therefore, this year, the first year started on 1st of October 2020. That is what we have said here. That is when the first year started. So first of all, we determine how many shares were issued and fully paid at the start of the first year. At the start of the first year. So where do we get that information? That information, we get it at the paragraph 1. At the paragraph 1, where we are given the equity balances at the start of year 1. Equity balances on 1st of October 2020. So what was the ordinary share capital? The ordinary share capital of the company is 20,000. I hope you can see that. Ordinary share capital. Share capital is 20,000. But now what are we interested with here? We're interested with the number of ordinary shares issued and free paid at the start of the year. To get that one, the number of shares issued and free paid at the start of the year, we're going to take the share capital, which is 20,000. Remember, these are not the number of shares. This is the value for the shares. So we divide that with the par value, which is still there, where we have the word share capital, which is 10. So this will give us the number of shares as 2,000. But you also have to recall that these figures are in thousands of shillings. Now, to this, then, what do we need to do? We then need to add the other shares which the company issued within year 1. So let's go to the addition information. The addition information, that's where you can get that information. So number 1, you're told on 1st of January 2021, this company issued 400,000 shares, ordinary shares, at full market price. So you have to check, is that within the first year, 1st of January 2021. You can see when the first year is ending. That year, September 2021. So 1st January 2021 is within this year. So we say on 1st of January 2021. So you give a short description of that transaction. We say there was issue at full market price. Recall what we said. Shares which are issued at full market price, they should be weighted on time basis. So the shares issued here were 400,000. Remember, our figures are in thousands of shillings. So we're going to take that as 400. And then what do we need to do? We multiply those shares with the proportion of time they were held. So the shares were issued from on 1st January 2021. The year ended on 30th of September 2021. So these shares were held for how many months? These are 9. These are 9 months. So we multiply those shares with the 9 all over 12, which is basically the same with 3/4. So that should give us 300. Because that is 3/4. 9 all over 12 is 3/4. Yes, so we are done with that. So let's move to the other transaction in note number 2. On 1st of April 2021. 1st April 2021. Is it within the first year, the second year? That is still within the first year. Within the first year. 1st of April 2021, which is basically how many months to the end of the year? We have April, May, June, July, August, September. This should be 6 months. 1, 2, 3, 4, 5, 6. So this is basically 6 months to the end of what? Of the year. We are told on that date, the company made 145 bonus issue to the existing shareholders. So we are told on 1st of April 2021, the company made a bonus issue. A bonus issue. A bonus issue, basically, these are shares which are issued free of charge to the existing shareholders. Are we given the shares which were issued? No. So we have to compute that because we are told the company made a bonus issue or made 145 bonus issue. How do we interpret that? 145 bonus issue. 145 bonus issue means that the company was to issue 1 share for, that is very important, the company was to issue 1 share for 5 shares which were held. For 5 shares which were held. So therefore, you come back here and you ask yourself, on this particular date here, how many shares were held? You can't get that in the question. In the information given to you by the examiner, you can only get that from your working here. You ask yourself, before this bonus issue was made, how many shares had been issued by our company here? Who can tell us? Before the bonus issue, how many shares had been issued? I'm told 24. Yes, remember the other question which we did was similar to this. Yes, we said take the shares which had been issued plus the actual shares which were issued here. The actual shares which were issued here were not 300, but you take the actual which were 400. So the shares which were held which were held before, they were 24. So what do we do? Cross multiply, then we divide. 1 times 24 divided by 5. And recall, these shares, because they are issued free of charge, do we weigh them on time basis? Do we multiply them with the proportion of time they were held during this year? No, we don't weigh them on time basis. We don't weigh them on time basis. So this will give us what? This will give us what? For what? 480. So those shares are not weighted on time basis. They are not weighted on time what? Basis. So we are done with that. Let's move to the other transaction on 3rd. On that, we are told on 1st December 2021. 1st December 2021. Is this within the 1st or the 2nd year? Is this a transaction for the 1st or the 2nd year? When was the first year? When did the first year end? That is September 2021. So these are transaction for year 2. So we are going to use it in computing the diluted earnings per share. Sorry, in computing the weighted average. In computing the weighted average number of ordinary shares for which year? For the 2nd year, not within the 1st year. And then so we skip that one. Let's go to note number 4. In note number 4, there is still some information we are given in the last sentence of note number 4. On 1st of June 2022, holders of 1.5 million loan stock exercise their conversion option. Exercise Exercising their conversion options means they converted them into ordinary shares. But you can see that is a transaction on 1st of June 2022. 1st June 2022 is within the second year. And then number 5 is about tax rate. Number 7 is about dividend. So it basically means that during this year, we don't have any other transaction for the issue of shares. So what do we need to do? We add all this, which will give us 27 what? 80, 2780. So having that then, what do we need to do? I hope that is correct. So we need to proceed and we compute the basic earnings per share. Is my addition here correct? Should be correct, eh? Yes. So the basic earnings per share, we apply our formula. So we take the PATOS, which we have here, which is the 2346, divided that with one-nos, which we have here. This is our one-nos, 2780. So the answer here will be what? Shillings per share. Shillings per share. And that will give us what? Will give us what? To around 3 decimal places. To around 3 decimal places. Yes, 0.844. 844. Yes, I think in our case we are done. So then we have computed the basic earnings per share for the first year. We go to the second year. We compute the basic earnings per share for the year which ended 30th of September 2022. So we are applying the same formula, but we don't need to repeat the formula. So, but we need to have these two items. So let's start by computing the PATOS. So computation of PATOS remain the same. We are going to take the profit after tax, which is also known as the profit for the year. The profit for the year, and basically this one we have it at the paragraph 2. Under paragraph 2, where we have the profit for the year and after tax for the year 2022, which is 3612. 3612. And then I think to this we are only lessing the preference dividends. The preference dividends, and actually the preference shares issued by our company over the 2 years remain the same, because if you go to the addition information number 1 up to note number 6, there is no any information regarding additional preference shares which were issued. So therefore, the preference shares which were issued as at the start of year 1 remain the same in the 2 years. In the 2 years, that will not change. So basically, what that means, the dividends which were paid in this year will be the same, even in year 2, 10% of 8,000, which will give us 800. And this will give us 28 what? 2812. Is it 2812? Yes, 2812. Then from there, we proceed and compute the weighted average number of ordinary shares. So for the weighted average number of ordinary shares, we need to start with the shares which were issued and free paid at the start of year 2. So year 2, I hope you can remember year 1. This year ended on that year, September 2021. So the second year will start on 1st of October 2021. So what we need to do is basically to compute how many shares were issued and free paid at the start of the second year. At the start of the second year, if you equally, you can be able to recall the other question which we did. We said that you have to compute that. You have to compute that literally. So because we said majority of the student take that as the opening balance here, which is basically long, because we said some of the shares which are included here have already been weighted on time basis. But now at the start of the second year, the shares will be issued and free paid. So therefore, how do we compute the shares issued and free paid at the start of the second year? We come back to the information which we have here. So what we do, we know that at the start of year 1, the shares which were issued by the company were 2,000. And then here we consider the actual shares which were issued here. The actual shares which were issued were not 300, but they were 400. So we take 400. Then here we take the actual shares which were issued. The actual shares issued during the bonus issue were 480. So that means now at the start of this year, 1st October 2021, the shares issued and fully paid were 2880. 2880. So that's how we compute that one. So you don't use this one. Yes. So then let's consider the transactions which occurred in the second year. As far as the issue of shares is concerned, we start with the right issue. And I hope you can be able to recall what we said, is that this concept for right issue is very common. Actually, in all questions for earnings per share, you'll come across this. And I hope you can be able to remember what we did in the other question. So we go to note number 3. Additional information number 3, we are told on 1st December 2021, which you have said is within the second year. 1st December 2021, we are told this company made a right issue. Made what? A right issue. Remember, we said a right issue. This is the issue of additional shares to the existing shareholders of the company at a price which is below the market price. Now, what we said is that the shares which are issued by the company in a right issue, we split them into two components. Shares issued at full market price and the bonus element. The bonus element. But now for us to be able to do this, there are two basic items we need to compute here. One, how many shares were issued during the bonus issue? And number 2, we also need to compute something we refer to as the theoretical X-right price. The theoretical X-right what? Price. Theoretical X-right price. So let's start by computing the shares which were issued by the company during the right issue, because automatically in our case we are not given those shares. So we go back to note number 3, where we are told on 1st of December 2021, D Limited invited ordinary shareholders, for right issue, in the proportion of 144 at a price of 12 shillings. What does that mean? 144. We said you must be in a position to interpret that. 144 means that during the right issue, the company was to issue 1 share for 4 shares held. So the company was to issue 1 share for 4 shares which are held. And in this case, we are told the company was to, in the proportion of 144 at shillings 12. So what does that mean? It basically means that these shares, this 1 share which was to be issued during the right issue, it was to be issued at a discounted price of 12. At a discounted price of 12. And then you're told in the other sentence that the shares were quoted immediately before the right issue at shillings 15 per share. In other terms, these shares which were held before the right issue, each share in the securities exchange market, they were trading at a price of 15. Why do I need to have those prices? Is for the purpose of computing the theoretical X-right price. Theoretical X-right what? Price. And then in that case, we are told all the rights were fully subscribed. So the first thing we need to do here is to ask ourselves, so because the company was to issue 1 share for 4 shares which were held, we come back here and we ask ourselves, before this right issue was made, how many shares were held? In other terms, how many shares had been issued by our company? Our company, before the right issue, had issued these shares. These are the shares which were issued. In other terms, those are the shares which were held, which were 2880. These are the shares which were held before the right issue. And because the company was to issue 1 share for 4, then how many shares were issued during the right issue? We cross multiply, then we divide. 1 times 2880, divided that with 4. This will give us 720 shares. Is that correct? 720? Yes, 720. Then next, what do we need to do? We need to compute the theoretical X-right price. And actually we said Once you have your arrangement like this, then computation of theoretical X-right price becomes very simple. We say no need of using those formulas you are using in FM, but basically we said, well, provided you arrange your work like this, then computation of theoretical X-right price becomes very simple. What we say, or in terms of how we compute that, theoretical X-right price, we come here and we say that if before the right issue, you held 4 shares, if before the right issue, you held 4 shares, and each share was trading at a price of 15, that's what we know, then during the right issue, you are to be issued with 1 share. Make sure you write that down here at a price of 12. It basically means that after the right issue, as a shareholder of this company, you'll be holding a total of 5 shares. And these 5 shares will be having a market price of what? So to get the market price of these 5 shares, we take this times this plus this times this. So this times this will give us 12. This times this will give us what? 60. So then we add this, so which will give us 72. So it basically means that after the right issue, as a shareholder of this company, will be holding a total of 5 shares, and those 5 shares will be having a total market price of 72 shillings. So what we are interested with is the market price of 1 share after the right issue. We know the market price of 5 shares is 72. So to get the market price of 1 share after the right issue, we take 72 divided that with 5. So that we get what? Market price of 1 share after the right what? Issue. So this will give us what? This will give us what? Yes, I'm told this will give us 14.4. 14.4 what? Shillings. For 14.4 shillings. 14.4 shillings. So 14.4 shillings, this is basically the market price per share after the right word issue. And basically that is now what we come and we use here in splitting this. So then you have to recall the formulas which we are using here to do what? No, this is not so here, do you have to cram this? I don't think so. These are a little bit simple to remember. So provided you have this particular arrangement. Although even in FM, there is a formula which you are using, which is basically similar to this, computing theoretical X-right price. I can't be able to remember the abbreviations, but you're taking the shares held before times their market price before. Something like this. This is what you are doing in FM, times the 1 share which was to be issued during the right issue, was to be issued at a price of how much, and then adding these two, 1 plus 4. So you are doing something like this in FM. You're doing something like that. Though no need of basically cramming those particular formulas. Yes. So let's compute this one. Split these shares into 2. So to compute the shares which were issued at full market price, we said first of all compute how much amount was received by the company from the right issue. The amount received by the company from the right issue will be equal to the shares which were issued, 720, and these shares were issued at a price of how much per share? 12 shillings. So multiply that with 12 shillings. So that will give us the amount which the company received. Then divide that with theoretical X-right price, which we have computed here. And always this has a mark on its own. So 14.4. Then, because these shares are issued at full market price, we have to multiply them with the proportion of time they were held. So these shares were issued on 1st December 2021. When is the year ending? 30th September 2022. How many months do we have there? Those should be around 10 months. 2021, we have December, and then 2022, we have 9 months. Here we have 1, here we have 9. So they should be 10. So we multiply this with the proportion of time. those shares were held, which is 10 all over 12. Then we compute the bonus element. Bonus element, we said this one is equal to the total shares which were issued during the right issue, which are 720, minus the shares issued at full market price. The shares issued at full market price is not the answer we are going to get here, but basically what we have here. So we said come and repeat here. Come and repeat this down here. 720 times 12 divided by 14.4. And then we said that these shares should not be weighted on time basis. We don't multiply those shares with the proportion of time they were held, because these are shares issued at nil what? Consideration. Yes. So give me the answers here. So the issue at full market price, what are you getting? What are you getting? Bonus element, I'm told, is 120. Bonus element, I'm told, here is 120. Issue at full market price. Is that correct? Are those figures correct? Are those figures correct? Those figures, are they correct? Are the figures correct? Are the figures correct? Yes. Bonus element in ngapi? Is it 100 or 120? Okay, so I'm told they are correct. Okay, so then we need to check, do we have any other transaction within this year? And therefore, that concept of right issue is a concept you have to understand very, very well. This is one of the concepts whereby majority of the students do have a problem with dealing with what? The right issue. So if you check on the other question we did, we tackled, there was this concept of right issue was examined. Still here it is examined, and actually we'll be able to see in all questions for earnings per share, this concept is being what? Tested, right issue. Okay, so let's move to point number 4. In point number 4, we are told the company had in issue means the company had issued, the company had issued a convertible own stock of sh6 million, which carries an effective interest rate of 8% per annum. Its sh1,000 nominal value of the own stock will be convertible at the holder's option into 600 ordinary shares. So that is now what we have as the conversion rate, the rate at which those convertible own stock are supposed to convert into ordinary shares. And then you're told on 1st of June 2022, holders of 1.5 million own stock exercised their conversion option. Option. So exercising their conversion options means what? Exercising their conversion options means that they converted those particular own stock into what? Ordinary shares. So here, what do we need to do? We need to compute the ordinary shares which were issued on conversion. On what? On conversion. And actually, we are told that took place on which date? On 1st of June 2022. What is a short description of that transaction? A short description is that on this date there was conversion of convertible own stock. Conversion of convertible own stock. Make sure you write that in full. Conversion of convertible own stock. So what we need to do here is basically to compute how many ordinary shares were issued on conversion. How many ordinary shares were issued on conversion? Because that is our interest here. The shares, the ordinary shares which were issued on conversion. So for us to be able to do that, we must have the conversion rate. Conversion rate, we are told, for each sh1,000 of the own stock, the company will issue 600 ordinary shares. The company will issue 600 ordinary shares. So in this case, we are told on this date, the convertible own stock, which were converted into ordinary shares, they had a value of sh1,000. 0.5 million. And take into account all our figures are in thousands of shillings. Equally, that figure, we take it in thousands of shillings. We omit the last 3 zeros. We let it be 1,500. 1,500, yes, 1,500, 1.5 million. 1.5 million in thousands of shillings. So these ones are the ones which were converted into ordinary shares. We need to determine how many ordinary shares were issued on conversion. We just cross multiply, then we do what? We divide. So we take 1,500 times 600 times 600, 1,500 times 600. We divide that with what? With 1,000. We divide that with 1,000. With 1,000, and then you have to recall we said that these ordinary shares which are issued on conversion, they must be multiplied with the proportion of time because they are treated as an equivalent of shares issued at full market price. As an equivalent of the shares issued at full market what? Price. So these ones must be multiplied with the proportion of time they were held. So they were held for how many months? June, July, August, September, because the year is ending September. Are they held for 4 months? Yes. June, July, August, September. So we multiply them with the proportion of time they were held. Which is what? 4 all over 12, which is basically like a third. And I think that should give us 300. That should give us 300. That should give us 300. 300. Is that the case? Yes, that should be the case. So basically, do we have any other transaction for the issue of shares? No. Note 5.6, no. So what we need to do is we add all this. Add all this, we get now the weighted average number of ordinary shares. Weighted average number of ordinary shares. Weighted average number of ordinary shares. Weighted average number of ordinary shares, the total here. The total. And the total is what? The total is 38. The total is 38. Then we compute the basic earnings per share. The basic earnings per share for this year by taking the PATOS. PATOS, we have it here. 2812 divided by 38, which is 1/0. The answer should be what? Should be what? Shillings per share. So at least 3 decimal places, 0. What? 0. What? There is around 3 decimal places. Okay. Yes, so that is basically the what? The basic earnings per share for that year. Basic earnings per share for that what? For that year. And basically, we are done with computing the basic earnings per share for the 2 years. And that's what was required there. That's what was required. So then I want us to do the last part now. The last part of that question. So the last part, Roman 2, we are required to compute the diluted earnings per share. But in this case, we are required to compute the diluted earnings per share just for 1 year. The year which ended 30th of September 2022. 30th of September 2022. Recall, in this case, we have said that for you to compute the diluted earnings per share, basically you need to follow 3 steps. 3 what? 3 steps. 1, we have said that you need to go through the information which is provided to you by the examiner. You do what? You identify the potential ordinary shares. That is the first step of identifying the potential ordinary share, or basically shares, which the company had in the year under consideration. In the year 2022, which potential ordinary shares was this company having? And actually, in this case, you have said when checking those potential ordinary shares, what do you check for? One, any convertible security which had been issued by the company, and number two, any stock option. Had the company granted the employee stock option? That is the first thing. Then number two, you proceed, you compute the increase in earnings, increase in number of shares for each, and then finally you compute what? The diluted earnings per share. So therefore, the first thing we need to do is we go through the information which is given, we check which potential ordinary shares was our company having in the year 2022. So in this case, we'll be checking whether the company had issued any convertible security, like convertible, I think in our case, we have convertible own stock, and also whether the company had issued convertible preference shares, whether the company had granted the employee stock option. So what we know as per the information which are given here, there is nowhere we are told the company had granted the employees the stock option. Number two, if we go to the information we have at paragraph 1, those preference shares which are issued by the company, they are not convertible. So we only consider them as potential if they are convertible. Are they convertible? No. So the only information which we have is on note number 4. Note number 4 about the convertible, about what? The convertible loan stock. So this is actually the only potential ordinary share which the company had in the year 2022. So basically, having this, we need to proceed and we compute the increase in earnings, increase in number of shares. But basically, before we compute that, there is some information which is very, very important, which we need to analyze here. Because it will help us in terms of computing the increase in earnings, increase in number of shares. Can we go to note number 4? In note number 4, we are told that this company had in issue convertible own stock of sh6 million, which carries effective interest rate of 8%. And then you're told that each shillings 1,000 nominal value of the own stock can convert at the holder's option into 600 ordinary shares. And then you're told that on 1st June of 2022, 1.5% of the own stock were converted into what? Were converted into ordinary shares. So what basically does that mean? It basically means that at the start of this year, this company had issued convertible own stock, which had a value of sh6 million. That is basically at the start. And actually, we know that this year ended on that year of September 2022. It started on 1st of October 2021. So at the start of the year, the company, the convertible own stock issued by the company, they had a value of 6 million. But we are told in the last paragraph, the last sentence or the last paragraph of note 4, on 1st of June 2020, 1st of June 2022. And actually, we have said 1st June 2024. These are how many months to the end of the year? We have June, July, August, September. These are 4 months to the end of the year. Automatically, here we have 8 months. So on this date, convertible own stock, which had a value of, let's have this figure in, which had a value of 1.5 million. This one were converted into ordinary shares. So if they were converted into ordinary shares, the convertible own stock, which then were not converted into ordinary shares, they had a balance of what? 6 million minus the ones which were converted. So automatically, the ones which were not converted, they had a value of what? Of 4.5. That information is very, very important in our case here. Very, very, very important. Very, very what? Important. Very, very important. Very, very important. So therefore, having that, we need to proceed and compute these two items. One, we need to compute the increase in earnings. And actually, in this case, we compute the increase in earnings. Basically, by assuming that our convertible own stock were converted into ordinary shares. And actually, I've given you the formula for computing this one. We have said this is computed by taking the interest or computing the interest which was paid, multiplied that with 1 minus tax rate. That's why you can see in our question, there is somewhere we're given the tax rate. That is in note 5. Is it note 5? Yes, we are given the tax rate. So therefore, what we need to do is to compute how much interest was paid by our company during the current year. So let's be attentive here so that you see how we compute the interest. So now, to compute the interest, we need to start with the first 8 months here. In the first 8 months, the own stock issued by this company had a value of 6 million. So meaning that in the first 8 months, the company paid interest for own stock, which had a value of 6 million. But now, once you convert, for example, if you had bought this convertible own stock, once you convert them into ordinary shares, you'll not be entitled to interest because you have converted them to ordinary shares. So meaning that for the last 4 months, the company paid interest for own stock which had a value of 4.5, the ones which were not converted. So therefore, to compute the interest, first of all, we compute the interest paid for the first 6 months. So first of all, what is the interest rate? The interest rate is what we have in note number 4, 8%. So in the first 8 months, we take 8% of 6 million. But remember, we are going to work with our figures in thousands of shillings. This will give us the interest per annum. But what are we interested with? We're interested with the interest for the first 8 months. Multiply that with 8 all over 12. So that will give us interest of the first 8 months. Then to this, we add the interest for the last 4 months, which will be 8% of their own stocks, which were not converted into ordinary shares, which had a value of 45. So this will be per annum, but we're interested with interest for 4 months out of 12. So this basically is the interest which was paid by the company for the whole year, for the first 6 months, for the last 4 months. Then what do we need to do? We multiply that with 1 minus tax rate. 1 minus 0.3. So tax rate is 0.3. So can we say that is just 0.7? 1 minus 0.3, which will be 0.7. So that's basically how we compute the interest which was paid by the company. And then you have multiplied that with 1 minus tax rate. 1 minus what? Tax rate. I hope you can see what you have done there. What you have done. We have computed interest for the first 6 months, for the first 8 months, and for the last 4 months. So give me the answer here. The answer here. This will be for 80. Yes, I'm given a figure. I hope that is a final figure. I hope that is a final figure. 308. Okay, sawa. So that is the increase in earnings. So then number 2, we compute the increase in number of shares. Number of ordinary shares. Number of ordinary shares. Now, for us to compute the number of ordinary shares, we said we use the conversion rate. The conversion rate which is given. The conversion rate, we have it still in note number 4. In number 4, we have the conversion rate, which we know is that for each shillings 1,000 of the convertible own stock, the company is supposed to issue how many ordinary shares? The company is supposed to issue 600 ordinary shares. Ordinary shares. Now, when computing the number of ordinary shares which would have been issued, we also need to record this information here. So for the first 8 months, the convertible own stock which were issued by this company, sorry, they had a value of 6 million. So basically, this will apply for the first 8 months. For the first 8 months, and then for the last 4 months. For the last 4 months, no need of repeating the conversion rate. So for the last 4 months, the convertible own stock issued, they had a value of 45. So basically, what we need to do is to compute how many ordinary shares would have been issued, assuming they were converted into ordinary shares. So first of all, we deal with the first 8 months. So we cross multiply, then we divide here. So we have 6,000 times 600, this times that, divided by 1,000, this one. So because we are dealing with what we have here, so this times this divided by that, and then we are saying that we will apply for the first 8 months out of 12. And then the last 4 months now. So what do? Now we ignore this. We take this times that times this. So we take 45 times 600. 600 is 600. Divided that with 1,000, and then that will apply for 4 months out of 12. So that is basically how we compute the number of ordinary shares which would have been issued, assuming these particular ordinary shares were converted into ordinary, these convertible own stock were converted into ordinary shares. Yes, so give me the final figure answers here. Give me the final answer. And the answer which we get here, these are the shares. These will be shares. This will be shares. I'm told by Regina here, the answer will be 3,300. The answer will be 33. I hope the rest are getting 33. 33, 33. That's what you're getting, 33. That is 33. 33. That is 3. That is 3. That is 3. Yes. So basically having that now, finally, what do? We compute the diluted earnings per share. Diluted earnings per share, you have to recall the formula. We take the PATOS, we divide that with 1/0. Then to the PATOS, we add increase in earnings. And then to this, we add increase in number of shares. Increase in number of what? Of shares. Increase in number of shares. That's basically how we compute the diluted earnings per share. So recall, we have already computed the PATOS and 1/0 for 2022. So the PATOS was this one, 20 what? 2812. And then I think our 1/0 here was it 38 or 33? 33, yeah? Yes, 33. And then now to this, the PATOS, we add the increase in earnings, which you have computed here. Where do we have the increase in earnings? It is 308. 308, and then to the 1/0, we add the increase. This was 38, eh? This was 38. Yes, and then we add the increase in number of shares, which is 33. So we compute now the diluted earnings per share. The diluted earnings per what? Per share. Diluted earnings per share. So what are you getting here? Zero point what? Yes, 439, eh? 0.4 what? 439 shillings per what? 𝗏𝗂. Yes, so basically that is it, that what was required as far as that question is concerned. What was required as far as that question is what is concerned, computation of diluted earnings per 𝗏𝗂. Yes, so I think if you check on the papers, the most recent papers, I think 2023 and also 2024, you'll also be able to see there are other questions. I think you can just attempt one of those questions, because I think we definitely have to do another one. Maybe you do like one more question and then we proceed to something else. So just check on any other question from the most recent sitting, you attempt on the same. And then once I think we meet in our next session, what we will do, we will, I think, do one question and then maybe we proceed to the other topic, Sasa, because I think we need to do another question, because this question had just one potential ordinary share. So you may come across questions having two or more potential ordinary shares. I want to show you how to deal with such questions whereby you have two or more potential ordinary shares. Yes, so for today, therefore, I want us to stop at that particular point. Unless maybe there is a question, unless maybe there is any question. Any question?